Hello, everyone. Welcome back to the RashInvestor.com's weekend frivolity. This is our Sunday offering.
Hello, everyone.
And it looks like
Welcome
we
back to
are live on YouTube, so that's good to see. Rocking and rolling. I was really pleased to see that basically the level oneers are just rocking it this morning. Grim running that class like a boss. And Alex, our TA, both of you guys totally representing TRI so well. I'm so proud of you. I mean, I would totally, maybe it's a beard thing. I don't know. Both of you guys got some pretty handsome beard action going. Maybe that's it. But anyway, was listening to you guys. Students couldn't be in better hands. Nice and calm, very responsible. Beard action going today, and somebody decided to turn their microphone on. Hello. Speaking of calm and conservative and level, got to be able to roll with those punches. And I see Satoshi. I think he really needs to be heard. Is there something on your mind, sir?
level. Got to be able to roll with those punches.
Okay. Well, Joshua tried to mute Mr. Satoshi, and then Mr. Satoshi decided he needed to be heard. So if there is something that you'd like to talk about, Mr. Satoshi or Miss Satoshi, whoever you may be, feel free to maybe type in the lounge, anything like that. A question, more than happy to help. I see we have some faces on here I haven't seen before. So by all means, if you have any questions, feel free to ask. And I see, of course, we got some of our all-stars from on the other side of the pond. Jamie's popped in here. Nice to see you, Jamie. In fact, Jamie has got, he's sort of taken the fundamental analysis that Krim was, kind of talking to you guys in a level one about today. Jamie's actually taken a lot of the macro top-down analysis to the next level. And he's actually even created a really cool offering, sort of a mini course. And as soon as Jamie's ready, I'm more than happy to endorse that product. And I don't know how we can set that up for you, Jamie. But great to see you. You're writing week 6, so right, so it's already into 6 weeks, eh? So Grim, we've already got a customer there for you, Jamie. So I think we'll all collectively take Jamie's course when it's up and running. But it just goes to show that if anything, not a bad dovetail, really. The educational program that I teach is basically a nice sort of, we're just scratching the surface. I mean, how deep down the rabbit hole do you want to go? I think I've told you guys repeatedly, especially for new level oneers, you could easily create a career path out of any one of these veins that we're just briefly tapping into. And I noticed that, someone like Jamie, and that's the great part about this, is I never know what specific sort of field of study within this thing called rational analysis, looking at both technical and fundamental and quantitative and all that. I never know specifically what's going to appeal to any one particular student. And it's great to watch. I mean, this is why I like to call myself the gardener, because I don't know, I'm handed a whole bunch of seeds. And people are just like, here, Brad, I'm a seed. Can you help me grow, please? And I get to plant you and water you and fertilize you. And but I never know what's going to sprout up. I have no idea. I'm just the gardener, right? And Jamie's a great example where he's blossomed into this awesome fundamental analyst, top-down macroeconomic analysis guru. And he's even built his own little offering. And I would highly suggest all of you that once you get to sort of the level 3 and beyond, you become alumni on the site, really explore what really speaks to you individually, and let's help you grow and become better, become a mentor, become an instructor if you want, demonstrator of best practices. You want to be part of the TRI team. That's absolutely love that. So, hey, interesting start to today's offering. Seeing Jamie in the lounge here this morning for our Broiler Chicken show. And just a shout out to you, Jamie, as soon as you're ready. In fact, what we probably should do, and as soon as you're ready, let me know, is we'll pencil you in for one of the Wednesday, Thursday sort of open session windows on the daily brief, and you can just show us what you've got. And you might get like 20, 30 purchase orders for your little mini course just like that. That's because I would definitely sign up for it.
Yeah, not to butt in, but Jamie is brilliant. I highly recommend anybody that can't take advantage of anything he has to teach.
Yeah, so there you go. You're getting
Mike.
doubly endorsed. Bet you weren't expecting that, were you, Jamie? Anyway, great to see everybody. So let's get to work. And actually, what I thought I'd do is I actually, and I don't know why, but for some reason, I guess in the past week or two, I did see that the level oneers were doing this sort of strategic planning part of the course. And so I hadn't updated the long-term sort of Dow cycle charts and where we are, economic analysis sort of side. And this is the kind of stuff where we just don't have time, in the daily brief to get into this kind of stuff. So maybe not a bad idea. We just sort of start off with a couple sort of thoughts here, macroeconomics, sort of long-term cycles, try to help maybe the level oneers a little bit, sort of see the forest through the trees. So I updated a couple charts that I haven't produced in a while, and it looks to me like the Twitterverse seems to be interested in this information. And I would highly recommend, if you are in the level 1 program, but even all you level 2, level 3ers, hey, do you have your journal out today? Is there anything you learned today? If you haven't seen this chart or you haven't updated this chart, or you're thinking of the market for a while, well, go and grab this link. In fact, here, this is on the Twitter feed. So, by all means, you should all be able to grab this. I'll just throw it in the lounge, just in case you're watching this later on the YouTube. And I disconnected the YouTube chat. I actually find, like, Grim actually recommended this to me maybe about a month or so ago. I had never seen this function before, but I'm in love with disconnecting the YouTube chat function now. I think this is great because if you're watching this, we've got the Rocket Chat Lounge. I mean, that's the whole point of the lounge, right? So get in there. You have questions. I've got the Rocket Chat Lounge just sitting here. If you want to interact with me, rock and roll. And so I just posted that long-term Dow chart in the lounge there, and it was basically this tweet. So if you don't have this image, please, for heaven's sakes, go and get it and throw it in your notes, because this is pretty darn important stuff. And really, what this is basically the past 100 years of capitalism. This is actually the transition of us transitioning from a society of despots, society of aristocrats, into a democratically elected society. Everything about this is all sort of contained in this image. It's quite remarkable. This is a image of the evolution of fiat currency, where in essence, fiat currency didn't exist here. Fiat currency was brought into existence here, and now we live in a world where we don't, not only are our currencies themselves worthless, but our governments actually don't even have any responsibility. They can go out and take as many credit cards out as they want. And oh boy, have they ever taken a lot of credit cards out. So this image I would love for us to do a study of this for the next 100 years and to see how our society evolves through that. My hunch is you're going to see lots of sort of ebb and flows. So I think what we have to understand is that this asset, the Dow Jones Industrial Asset, is nothing more than an equity proxy. So what does that mean? Well, it's a proxy on earnings. And you have to understand that an economy expanding, earnings are going to expand. Economy contracting, earnings should contract. And in a world where we didn't have democratically elected governments, so aristocrats, kings, queens, sovereigns, all that kind of stuff, they didn't give a shit how the public felt. Who cares about the bourgeoisie, right? It's not really a problem to them. What is a problem is if your purchasing power of your currency starts to diminish, then you can't go out and fight wars and stuff with your neighbors, right? You can't pay for weapons and stuff. So in this sort of, late 19th century, early 20th century world, where the world, you could argue that here is World War I, right? This was, in essence, the end of World War I was the end of that aristocrat world. And of course, a whole bunch of revolutions and stuff happened around the world and stuff like that. And we transitioned into this democratically elected society that we live in. In this part of the cycle, this is actually exactly how equity should act. If you have a nice, strong, stable currency and governments are responsible and they balance their books and they pay their bills, equity in the form of the Dow Jones Industrial Average should grow as earnings grow and as the economy grows, and the demographic influences on society cause the economy to grow, i.e. people, are heading into the workforce years. And as that demographic bubble, as they enter the workforce years and more of them go out and get jobs, more and more economic activity happens. Money multiplier effect, right? Every dollar spent in the economy generates $3 of economic activity. And then conversely, as the generation shifts from working years to then into retirement years, in essence, leaving the economy, then growth obviously should unwind, right? Less workers, less productivity. And then those people that were working, they're not going out and spending their money on fancy new cars and stuff. No, they're squirreling their money away to save for retirement. And, they've got to be on very fixed incomes, and there is no or more income for them. If anything, they're unwinding. So ironically enough, this is actually exactly how the equity cycle is supposed to look. Boom, bust. And if you go back and you look at, like, say, 19th century equity markets around Europe and stuff like that, and, we've heard about the tulip bulb craze from the Netherlands back in, like, the 17th century. This is how capitalism works. Boom, bust, boom, bust, boom, bust, boom, bust. And if you think about, like, Dickinsonian sort of, Scrooge and debtors' prisons and stuff, this is the classic model of capitalism. The only problem with that, of course, is that it's predicated on the government not being susceptible to being ousted out of power should we have to go through these contractions. And of course, historically, there's a famous sort of, study that the leader of the United States of America right here at this time, Mr. Herbert Hoover, basically said, look, if you invest in equity, it's your own problem. Don't come to the government to help us solve your problems. The market unwinds and Mr. Herbert Hoover gets run out of Washington on a rail. Where's villain in human history, right? Nonsense. The Republicans, and Mr. Hoover was a Republican, he learned a really hard lesson, and all Republicans following him learned a hard lesson. In fact, every single politician since Mr. Hoover, their number one priority, and I've even heard politicians like Obama and like Clinton and like Bush, not so much this current guy, but I've heard all these old politicians all say, I will not be the next Herbert Hoover. I will not be. That is absolute priority number one. Don't let this happen. So in this next cycle, so that's one full cycle. So this next cycle, boom cycle, then this should be bust cycle. You can even see that we're starting to M out here. And somebody came along and tinkered with the mechanics of the system right here in 1971. That was Mr. Richard Nixon, a Republican, same political party as this guy. I will not be the next Herbert Hoover. Took the US dollar off the gold standard. So as a result, what you have to understand is as of this point right here where my mouse is, this thing over here, these price labels have changed. Why? Because if you pull up a gold chart and you look at the price of gold, a hard asset, an asset that should stay relatively the same value, it went absolutely nuts over this period here, meaning that this thing that they use to value this growth asset, this growth proxy, stocks, equity, is being fucked around with. I mean, that's just the simple truth of the matter. So in that particular case, governments were allowed, well, actually, I beg your pardon, governments were not allowed to run deficits, were not allowed to run debt. That was a big no-no. But the big sort of disconnect was we are going to fuck around with our currency, dilute it so that we don't let this happen. So that's sort of why this cycle here went sideways, where it should have basically regressed back to where its starting point. Well, the reason why it didn't come down here is because this is an accounting trick. The value of the US dollar itself, this number thing over here, has been altered. We go through the next generational cycle, big growth cycle. And then what's really interesting is that into the dot-com boom, right, year 2000, you can see the, excuse me, the pivot. And what I find really cool about this, and I was actually quite shocked, is 210 bars almost exactly. I mean, it's freaky how shockingly, consistent this is. I was actually quite surprised because basically 35 years, half of 35 years is 17 and a half years. And 17 and a half years times 12 months comes out to 210 bars. And I frankly, when I drew this chart up this morning, I was shocked at how actually precise these damn 210 bar cycles are. But long and short of it here, dot-com boom, this is the baby boomers. But we have a problem here. And, you can see that the pace of growth obviously accelerated and went much steeper here. But through this period here, they went and changed the rules again. So through this period here, remember, back here, governments were not allowed to run deficits, not allowed to run debt. Then a guy actually came to Washington, a Republican, and basically said, well, you know what? I think we can run debts, right? This whole George Bush Sr., he actually called it voodoo economics. How can you run deficits? And, hopefully in the course material for your level oneers, we sort of explain because of the money multiplier effect, the logic goes that if I spend $1 that I don't have and it generates $3 in economic activity and I tax the society at 33%, then technically if I go and borrow that dollar, generate $3 economic activity and collect $1 in revenues, then in essence, it's a zero-sum game. Voodoo economics. And of course, it's entirely predicated on one thing and one thing alone. The economy must grow. If the economy doesn't grow, all hell breaks loose. So that is the world that we're living in now. And I've noticed that some people are asking, well, if this is theoretically a fear cycle, then why are equity prices continuing to press higher? And the answer, again, is it's an accounting trick. Not only, right, does the economy have to grow because of these government deficits, that means that the dilution, remember Mr. Nixon started this off by taking the U.S. off the gold standard here. Well, the dilution of this thing has gone even more parabolic. And it'd actually be interesting if we overlaid sort of like the total national debt over this, right? You'd see that the debt is just going through the absolute roof. So unfortunately, and this is a bit of a trick that they're playing on us. Yes, equity prices are moving higher, but the question ultimately is this thing over here that they're valuing equity prices, is it actually staying the same? And the answer, of course, is no. I don't know, and of course nobody does. I mean, maybe we blast off through the top of this channel and then have to come back and actually tag the top of the channel at the end of the cycle. I don't know. Nobody knows the future. I will say one thing, though, that I've seen happen quite often is that it seems that at the end of these cycles, the market has to actually come back and sort of check the point at which that it finished the cycle. I've seen this happen repeatedly. And what I've noticed here, which I think makes a lot of sense, is that the dot-com boom peak is about 11, 12,000 on the Dow. And interestingly enough, here we are up at about 26,000. I also noticed too that usually during recessions, and we can go back and we can look at the data, but usually during recessions, the stock market takes a 50% haircut. That's actually pretty normal. So if we do the math, even at 26,000 now, then 50% haircut takes us back down to like 12, 13,000, whatever. Maybe 15,000 is the pivot. I don't know. But my hunch is that there has to be some sort of check of this red box before we can actually start this next growth cycle in earnest. And I know it's very difficult for people that are very new to the market to see this. You're thinking, okay, well, it looks to me like stocks are just going to continue higher. I think we're already in this growth cycle, but I would actually make the argument that we're not on this cycle yet. We are still in this cycle, and what actually marks the transition is the recession. You probably heard me talk on the site quite a bit about things like the yield curve. Where's the best place to show you that? If we just go to stockcharts.com, I mean, what you guys have to understand is that markets, especially when you first come to the market, you're like, oh yeah, that looks like business as usual. I can tell you absolutely without a shadow of a doubt. I just have to find the link here. Here we are. This needs to have some sort of check to it. I suppose it's got to load first. There it is. That's straight up, and that is completely unsustainable. Now, maybe we bump around here and it takes some time, but at some point there will be a check. And when we, and it's interesting actually, because the level tours, we just did this. Alex, can you see the horizontal support and resistance study building here? Alex is in the level 2 program. Joshua, can you see the horizontal support and resistance level building here? I can see it. Like it looks to me like this high, this high, this high, this low, that high. Can you see the cluster? So, and the interesting thing is that's just about 50% of where we are right now. And if you don't think markets can lose 50% of their value in recessions, look at this. Is the dot-com peak, right? That's, what is that? That's 14.5. And the bottom here is, well, 9. Oh, 8, right? Well, that's getting pretty darn close to there. Maybe that's not exact, and this is a clothesline, so you don't know what the intraday bars are. There's 800. That would be 1600. So that could be pretty damn close, right? There's 1460 or something. Did we get up a little bit higher there? There's 1500, so that would be 750. So I don't know whether we, on an intraday basis, got down there, but just on a clothesline basis, you can see prints down here at 800 and change. So that's just about 50%. And then the same thing here, right? This high was 1450, and this one we did get down into the 750%. So, don't be shocked if the next recession we have to lose 50% of the value of the market. And you can, like what's kind of funny is, the level tours just did horizontal support and resistance, and you can sort of see the Wyckoff check, right? If anybody wants to understand Wyckoff, in essence, that would basically be the market coming down, checking that breakout, and then continuing on its way. So ironically enough, the numbers are actually lining up pretty nicely. Yeah, well, you could do a low to high trend line as well on here. Might go like, and this is a tough one, right? Do we go there to there? That low to that high? You could also go that low to this high. That would be very steep. Could do this high to that low, this high to that low, draw some support lines. Maybe even that pivot high against that pivot low. But that's another conversation for another day, Alex. I just wanted to simply outline the fact that, recessions typically market does lose 50% of its value. And if you look at it from this perspective, holy free holies, I mean, we've literally just gone straight up. Now, the good part about it is, I mean, everybody tell me. And I think you level oneers now have done this. So hopefully you guys, yeah, it should be. Can somebody go into the lounge and answer Amir that, yes, it should be available? But who can tell me? Is the yield curve itself signaling we should be getting ready for that recession? Are we there yet? Nope. Very good, Rocker. Right? As long as this says normal, we're fine. Right? What we have to worry about is when we get to like flat. This was George Bush Jr.'s time period. And of course, somewhere in all of this, right, you actually see this yield curve tool go inverted. Right? And then once that sort of flashes, you can see how long it took the market. Usually it takes about a good 6 months for the market to roll over. And then, right, here's the .com boom, right? You can see I just clicked on it right there, inverted, and within 6 months, see you later. So we can just simply said, like Rocker said, we're not there yet. So we don't have to worry about it just yet. But what we do, we really should, people, right? We really should acknowledge where we are in this cycle. And really, I would make the argument that the next, you millennials, your greed cycle, it can't start without a check. We literally have to hear some of these dinosaurs from the previous generations, the previous cycles, they have to go bankrupt. They have to be wiped out. It's as simple as that, guys. There's got to be a big check before we can get into the next cycle. I don't know whether it might be Deutsche Bank, right? Jamie's saying Deutsche Bank's in trouble. It might be. You know, it's interesting. I was listening on YouTube. There was a guy that was, he said he came back from the year 2036. And in his timeline, I don't know whether you guys have seen those videos, the United States of America broke out into a civil war, which is kind of interesting, eh? Who knows? You know, you can't write better fiction than reality, but I would definitely say that before we can get into this growth cycle in earnest, we really do need to have some sort of check. In fact, they call it like a Malthusian check. But that's slightly different. Anyway, so the point of the matter here is, you know, anybody looking at this chart should go, holy Jesus, this market's been going straight up for like 10 years. Yeah, at some point there has to be some sort of natural check. We know that in recessions, market lose 50% of their value. We know based on the historical consistency of the yield curve that it's not today. Could this take another year to play out? Sure. Could it take a couple years to play out? Sure. Does anybody know? Here's a fun assignment for all of you guys in the Hangout with me. Who can tell me the date at which Jupiter and Saturn's planetary paths cross? My hunch is that recession is probably going to be somewhere around then. All right, and anybody watching this later on, that's a fun assignment. Just put the video on pause and go, okay, what the hell is he talking about? Okay, how the hell do I figure this out? Thank you, Alex. So, Alex, remember we always say, Alex, I don't know whether you remember, I told you guys this in previous terms, but almost always, recessions occur in years that end in like 8s, 9s, 0s, 1s, and 2s. So here we are at the end of 8. That means we got 9, 0, 1, and 2 coming at us 100 miles an hour. And as Alex pointed out, the Jupiter-Saturn cross is in the year 2020. And, of course, we also have some fun crypto stuff going on in 2020 as well. But that's another conversation. So, okay. So hopefully that helps you understand that this is an asset that stable currency, governments are not screwing around with the balance sheet, no deficits, low government debt, king dollar, right? You could argue this is one of the reasons why the United States sort of took over economic dominance in the world. Very strong currency. This is a world where the politicians didn't want to let this happen. They were democratically elected politicians, which is so ironic, eh? Because Nixon goes to all the effort to try and make sure that this doesn't happen again, and he doesn't get run out of Washington and painted as a big villain. And yet that's what happened to him anyway. How ironic, eh? But anyway, he puts all the pieces in place, dilute the currency, keep the market up. But at this point, government still had to balance their books. This market, we growth cycle. Now we're in a world, currency is diluted, sacrifice the purchasing power of the currency, which means sacrificing the standard of living. And all of you must have seen in your lives prices of everything in your life going through the roof. I always like to use the loaf of bread indicator. I don't know whether you guys are aware. When I was a kid, right here, I used to be able to go to the grocery store and buy a loaf of bread for 25 cents. 25 cents. You know, in this world here, that loaf of bread cost me a good, Jesus, I was at the grocery store, it's like $3-4. So in essence, the currency itself, just from here to here, is basically fallen by a factor of 10. Anyway, not only do we have no value to our currency, and that's why a lot of you are interested in Bitcoin to begin with, but we also have governments that they're basically crack addicts when it comes to spending. They can't control themselves. And deficits are just getting bigger and bigger, and it's like they don't even give a shit. At some point, this will come home to roost, and it's your and I standard of living. And that's why this thing, I reckon, Bitcoin has come into existence, is we've just had enough. And we're trying to figure out a way out of this sort of Ponzi scheme. All right. And this is just a pure assumption that everything stays the same. You never know, man. I mean, maybe the stock market has to come down. You know, keep in mind, this is a megaphone pattern. And in the level 1 course, we actually have on there the Da Vinci Nightmare. We used to have a guy on the site, and it's interesting because Dav used to be around the site all the time, and not so much anymore now that he's sort of living in his little barren life down in South America. Anyway, the point of the matter here is he was rooting for the whole system to collapse. And if you draw a megaphone off of this low and connect it off of this low, well, that actually paints a target here. But I'm not here to tell you exactly what our future is. Nobody knows what our future is. But what I will say is this is quite shocking how the demographics, these 35-year cycles, seem to play out very, very consistently. And hopefully that helps all you level 1ers understand why this looks differently from one fear cycle to the next fear cycle to our current fear cycle. And unfortunately, what it could mean is that at some point we have to, I mean, technically speaking, you could do a 50% roll off of whatever this high is all the way back down to this low. And if at some point the market just says, fuck you, man, we're not going to take your bullshit anymore, they might have to bring this thing all the way right back down. Really, I suppose you could argue that, you know, Malthusian check, horizontal support and resistance. There's a lot of horizontal support and resistance right around here, about 200-300 on the Dow. But I don't think we're going to go there anytime soon. Anyway, so the point of the matter here is I just don't want people thinking right now that we've already started into the next cycle, because I don't think we have. We have to have some sort of recessionary check. And keep in mind, this is like a monthly chart. This is a whole century. If this has to take a few bars, look how long it took for this to roll over here. You know, if this has to take a year or two to ultimately roll over and then we go into the recession, that's fine, right? But the long and short of it here is usually markets correct 50% through recessions, equity markets. And that seems to correspond really nicely with the previous breakout levels in the bottom of this channel. And then we can start the millennials growth cycle. Oh boy, that was a mouthful. Okay, I think I'm going to leave it at that for today. It's interesting on the site. We talk a little bit about interest rate cycles. And here, hopefully, can everybody see the 70-year interest rate cycle? And you can make the argument that, hopefully all you guys on the site believe in M's and W's now. And we used to joke, and it was just common knowledge. Now, all of you guys who actually learn and understand this concept of M's and W's, this was like total, like super hush secret. Shh, don't tell anybody. This is how the professionals knew that the bottom was in the interest rate market. Because keep in mind, during this time, like 1986, 1990, 94, even really into the turn of the century, this kind of information wasn't known to the public. They didn't know any of this. You guys are so lucky that we live in a world where we can see this information so easily. But this used to be like a major hush-hush secret. Oh, I know exactly why the market bottomed and why the market turned in 1982, because the bottom was put in the bond market. And you'd say that to people in the public, and they'd be like, what? What the hell are you talking about? Well, the cool part about it is you guys all as TRIers, you see this and you go, yeah, well, duh. But the irony of this is this was like top secret information for a long time in the market. And when I first started in the market, and all the pros, right? I used to work with this guy, Jack Zaya. He used to always talk about this. I remember the day the market bond turned in 1982, right? And only understanding this chart does that make any sense whatsoever. What I find really interesting, of course, 35-year generational cycles is gee whiz. Look at this, and I was actually quite surprised when I pulled the chart up. Can you guys see that very noticeable head and shoulders? There's the shoulder. Neckline, head, neckline, shoulder, fail. I mean, it really looks a lot like this. And what's interesting is you can kind of see the bigger head and shoulders. Shoulder, neckline, head, coming back down to the neckline. Probably see a counter trend rally back up into these levels after this dump, right? And then play ourselves into this cycle, right? And then some sort of big check up here, and then hopefully you can see the even bigger fractal. Can you guys see the fractals? I don't know whether you can see that stuff or not. So I was actually quite impressed at how actually really clearly articulated this is. So it's pretty clear. And if anything, like especially new people to investing and stuff, we actually went through a period here of extreme abnormality. I'm not quite sure how the word goes. And I even posted in the lounge, like what you guys have to actually appreciate. There's a couple things about interest rates that I don't think most people really appreciate. The first is that these cycles take a long time to play out. They're very normal. But the second is, and here is sort of the 10-year treasury that I posted in the lounge. You can see that, 2.5%, that's actually a pretty good base. And you can see the run up from 1955 all the way up to 1980, 81. That chart that I was just showing you a moment ago, right, is basically that bottom or top in interest rates, but bottom in prices, right? That's this, right? And there's 1982. I remember the turn 1982, right? And then we just came down. And can you see the very symmetrical nature? This is interest rates, the exact opposite, right? So this is bond prices, right? There's the bottom and the top. This is the interest rates, the exact opposite, top, bottom. And this only goes to 2003. So if we actually projected this out, right, we would be down here, saucering and starting to turn back up. But what I think is really important that I don't think a lot of people take into account is if we look at interest rates over, say, a couple hundred years, and a lot of people don't really appreciate how significant this is. Us actually going into double-digit interest rates was very abnormal. That doesn't happen very often. And I would make the argument that the reason why it happened was a confluence. In 1980, the Soviet Union was at its zenith, right? That's when socialism was at its peak. And so as a result, you had things like trade unionism in the West was at its peak. Is that going to be inflationary or deflationary? What do you think, guys? Anybody? Any basic economist 101? If we have workers demanding more money and fair wages, is that inflationary or deflationary? Very good. It's inflationary. As well, you know, we had this Cold War, which meant that we had a lot of spending on things like military. Is that inflationary or deflationary? I would make the argument that this is abnormal. Really, interest rates only went to this absolute insane extreme because of the confluence of some pretty darn big economic global factors. And if we think about what's happening in our society right now, is the evolution of technology. Humans need not apply. Is that inflationary or is that deflationary? I would argue deflationary. So, interestingly enough, the factors that contributed to, and then of course, you know, is international socialism on the rise or is it on the fall? Are workers getting paid more or are they getting paid less? I don't know. International socialism, I would say international socialism is on the fall. I would make the argument, honestly, that before this cycle actually finishes, we have to go back to debtors' prisons. You know, a guy like Donald Trump, he would absolutely love for us to go back to the world of debtors' prisons. I don't think it's necessarily healthy. But I would make the argument that, you know, more right-wing conservative influences would rather punish borrowers and people that don't pay back their debts through the things like debtors' prisons than what sort of was developing through sort of the, you know, especially when we go back to that conversation about sort of the evolution of our society. Did I post that? I thought I posted that as well. I guess not. Where did I post that? I think I just had it on here. Anyway, I'm just having fun. Sorry, guys. A little bit of economics 101 here for your morning. Here we are, this. Right? Through this period here, international socialism was on the rise. Right? Things like debtors' prisons and stuff like that. You know, if you those people were, you know, burned at the stake, if you will, right? Communism, socialism, all that kind of stuff. Workers' rights, right? I would make the argument that that played itself out, and we're now, I, you know, especially with the collapse of the Soviet Union. Literally since that day, and I noticed like when I was coming out of high school and starting in university, the fall of the Berlin Wall. Do you guys remember that? In essence, that moment, all I heard was downsizing, right sizing. Have you guys ever heard that expression? Right sizing. And jobs and industry were leaving the West and going towards cheaper manufacturing. China, South America, Mexico, right? Especially for a lot of American jobs. They just simply went south of the border where the workers were paid a fraction of what they would have been paid in the States. So as a result, right, I would make the argument that we're moving towards probably lower interest rate environment going forward. I don't foresee us going back to sort of the double-digit interest rate world that we experienced here in the 1970s and 1980s. And then also, too, I would make the argument that these are very long, slow cycles. 70 years is 70 years, 70 years. We're probably not even really going to feel the effects of the change of interest rates until we get to like about maybe 2020 2025, 2030. And then we're going to be sort of like, oh, geez, do you remember back when money was so cheap? But we won't really see the sort of real shit hit the fan of this interest rate cycle, actually not until about 2050. And I'm going to be on my way checking out at that point. So that's sort of what I foresee. But I don't think that this interest rate cycle is going to be nearly as violent as the last one. But who knows? But I what I did want to mention to you, and I think this is a really great image, is this is sort of prevailing interest rates over the past, basically 200 years. And very, yes, you can see the spikes in interest rates, right? There was one, I suppose that was around the War of 1812, right? Then there was one here. This is the U.S. Civil War, right? And then, of course, this was, following the First World War. That's probably what a spike in interest rates is going to look like. I don't think we're going to go back into this kind of environment, double digits. The world's coming to an end. Given technology's influence on our economies, and then also the fact that international socialism itself is on the decline, I just don't see this kind of environment happening again. But only time will tell. That's Brian's rhetoric and his rant. It's interesting, on a sort of side note, somebody in the lounge posted this morning, and I think it just makes perfect sense. In a weird sort of way, the Canadian economy should have done really, really well through the last fear cycle, and it did. Greater demand for commodities, higher prices for those commodities. Canadian dollar itself went actually to a premium to the US dollar. But things just got absolutely out of control, which is typical for bubbles. Very normal. But so much so to the point where, and it's almost comical, really. A single family home in Vancouver, now they're quoting it costs more than $1.5 million for a house. And they're not even that good houses. They're just a single family home. I mean, this is ridiculous. You could take that same money and go down to the States and literally buy a mansion. Why would you buy a single family home in Vancouver? And the only reason I think is that this became a destination for capital fleeing out of places like China. Not necessarily natural demand. Now, the problem with the Vancouver real estate market, of course, is that it's extremely corrupt. It's extremely controlled. So, betting on a crash in real estate prices, I don't think is really that good because the market is like propped up. But there is lots of anecdote, and I thought this was almost laughable when you read this, because actually you go down to the bottom and it says here, just because they're doing this study, we're going to crack down on, dirty money, but they're not really. All this is just a study. And it even says here, the study is only meant to learn the mechanism of how money is laundered. So nothing's really going to actually change here. But it is just a great analogy. It's just yet another perfect sort of anecdote about what bubbles look like. And it kind of sucks because I'm here in Vancouver. I mean, basically, the local politicians have engineered it so that, a typical Canadian can't even afford to live in this city anymore. It's stunning the degree of the sellout-ism, if that is such a word. And either it means that, property prices are ridiculously overvalued, or, and it would be worse if it was this case, it means that the value of the money, this C here, is worthless. I hope it's not sort of emperor's new clothes. Turns out the value of the Canadian dollar is worthless, because Canada could be in big, big trouble if that's the case. But the long and short of it here, and I've been talking about this for a while, is sort of the Canadian real estate market's a ticking time bomb. And it was actually interesting because we're starting to see a little bit of that in the market itself. I was, I think over here. We've been talking a little bit. Here's the Vanguard Canadian capped real estate index. Interesting to see what this looks like on a weekly chart. Yeah, it doesn't even go that far back. Only 2013. I mean, you can't even really get good data on that. But you can start to see that, maybe things are starting to unwind a little bit here. We don't have any like massive M tops here like this. But maybe it has to start like this. I don't know. But I've been squawking about wanting to short the Canadian banks, and I can't fucking get into the damn trade. But it's another sort of good example of the sort of ticking time bomb nature of the Canadian financial system. This guy might actually go back and give us lots of data to work with. So let's see how bad the situation is. So that REIT index started there. Let's see how much further back this goes. Well, that's 4 hours. Let's change this to like a weekly chart. Let's see what we get. All right. So the last time that these things actually based, and again, Alex, can you see the horizontal support and resistance here? Right there. And here. So it looks to me like there's a base right around here about $30. So you tell me, is there a little bit of risk in this market? Seems so to me. I think you're probably going to have some support come in off of these old highs. All right. Look at that. Talk about horizontal support and resistance, eh? Damn. So there should be a hell of a fight here around $100, $105, and that makes sense too. It's a big century mark. And then, of course, if this market does just collapse, really probably we could, just reload zones. Not a bad sort of simple way to look at this. Boom. Coming in against these lows, that's good old Mountain Man. 78.6 against these lows. This is starting to look like an altcoin, eh? 88.6 is probably right down against these lows in here. So you can see, I mean, there's definitely potential for trouble here. There's no sugarcoating it. This has got a bit of risk built into this market, and everything that we talked about, and actually it'd be interesting just out of curiosity. Let's go see what that nickel buckle looks like. I don't know. Has anybody ever heard me talk about when the market's smiling at you? Are you supposed to be thinking anything? And this is, keep in mind, this is a weekly price chart, right? This is long term. So here's good old Canada, right? And what's interesting is the Canadian dollar actually went through those 2008 lows here. So, it's a bit of a challenge. I'd be interested. I know I saw some guys posting posts and stuff about the Australian real estate market. Interestingly enough, it's got a bit of a tighter top here. It almost looks like a big fractal, eh? Maybe head and shoulders-y kind of thing here. Maybe. Any way you shake it, it sure feels to me like the tide is actually already starting to turn on these. And this is exactly what we're supposed to be thinking about when we go through these long-term cycle pivots. Especially, fear cycle should be positive for the commodity-related currencies. It clearly was. I mean, you tell me. From 2000, right, there's 2001, up to, and this happened to be, 2011. That was a pretty damn friendly time period for the Australian dollar. All right, and then if we look at the Canadian dollar, should see basically the same thing. Through 2000, and this guy, he actually peaked before that 2007, 2008 peak. What's interesting about this, too, is that corresponds perfectly with the Chinese Olympics. So you could make the argument that that half of Canada's rally here was just based purely on the Chinese coming online, building out their economy, blah, 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 blah. As soon as that story was over, we've just basically been slowly regressing here. So, and this is the kind of shitty part about the way that they do these currency studies. Maybe we'll see it if we do this. You don't really get a really long-term perspective. Yeah, they only go back to here's 1980. So you can see, here is that last sort of greed cycle. This is what it did to the Canadian dollar, right? That's a pretty nasty cycle, right? There's that 80, right? There's there. Oh, that's 91. Oh, geez, that's only in the 90s. So we don't even get really a really great picture of the Canadian dollar. And it's too bad. This kind of like, those big hush hush secret kind of things in the market. If they just don't give us the information, then it's awfully tough for us to do. That doesn't do any good. That's useless. It's very tough for us to do these studies. All right. So I can tell you guys all with confidence that back in the late 1970s, the Canadian dollar was actually trading at a premium to the U.S. dollar. So this was back up here in the 1970s, 1980s. So basically, it does its full cycle. And if anything, if you want to be bullish of the Canadian dollar, what we really want to see is this kind of action down in here. Looks a little too volatile right now. If anything, what I'm kind of thinking, and it scares the hell out of me, but I'm kind of thinking that we've got that. All right, you can see that channel. And even if we go conservative, boobity boo, and then boobity boo, believe it or not, I could actually see a 50-cent Canadian dollar. It wouldn't totally shock me. It would suck. It's going to make our standard of living here in Canada really shitty, but it wouldn't shock me one bit. So Casey, make sure you have your appropriate plans in place for your babies. All right, because I see Casey over there. I don't know whether we have any other Canadians in the group here. No, I think it's just you and me, buddy. Okay, so that's my sort of talk about big picture economics. I'm just having fun blabbing away here. I hope you guys got some sort of value out of that. We probably don't need to talk too much more about the stock market today. Quick boo at crypto tastes great. I know a lot of people are kind of like hoping, okay, big bull market. One thing that kind of jumped out at me that surprised me was you notice that on the longs on LTC, they've actually M'd out here. I don't know whether that's sort of the LTC being our sort of leading indicator. I wonder if that's sort of suggesting that maybe the crypto rally is, stalled out a little bit here. I noticed that this morning. If we look at the weekly chart, basically the same levels that we talked about before. We had this bull-bear battle zone. The momentum in the market was heading down. And they were able to break that bull-bear battle zone. But, of course, they did it on a move to new lows. So very sloppy bottom here. Very ugly. And I even put a tweet out yesterday, or I guess last Monday or Sunday, saying if we can get up through this high, we'll actually issue an outright buy signal because that would be basically like a hammer reversal off of this range. And you can see this is the weekly chart. It will end, this bar will end today. We opened up, had almost no interest whatsoever in going higher, and have spent most of the week either substantially lower or coming off of those lows. We had actually posted, where the heck is it? Actually, I think it's over here. Yeah, here. Through this summer, actually, and I did this as kind of a fun experiment for you guys. And actually, I really did it for Julian's sake. But I wanted to demonstrate how I use RSI. And actually, interestingly enough here, I think this thesis is coming in here. Usually I can get a trade on RSI if I get two W's. What do I mean by that? Usually what ends up happening, like say through here, especially if you have divergence, yuck. Breakdown, the bull was fully in charge. This first M stops the bull. Bull, you are done right there. And then any subsequent M's actually become sell signals. So this little one right in here, and it's kind of fast and sloppy, but in essence, this actually becomes a cheeky little sell signal right in there. Right through there, that failure there, that was that dump. That was, in my opinion, a perfectly valid RSI sell signal that the market is actually heading down. And I don't know, it looks to me like that was pretty good signal. Boom, down you go. Then on the other side, we'll know that the bear is done when we start Wing. And you notice we came off V bottom, V bottom, V bottom, V bottom, V bottom. All right. Hey, we got a W. Awesome. All right there. And that occurred basically on this violent reversal right here. And you could argue that, just as we had a bearish divergence developing up here, there to there, there's actually a bullish divergence there to there, there to there, developing through here. So anecdotally, there was some pretty good evidence that, hey, maybe the bear has gone a little too far here. 1W, 2 Ws, you could actually make an argument. You got 1 W that fires here, the smaller one, and then this bigger W that fires here. You could actually make an argument that you're actually getting some momentum buy signals in here. And then I would make the argument that you got a really big momentum buy signal on the breakout through this W, and that was on this bar right here. And not a bad signal. Boom, up she goes. Pretty good rally. M'd out, bull push has stopped. But interestingly enough here, we never really did get that second M. And yes, the market did come down in a big hurry. So I think our first M, and you could argue there's also a head and shoulders top here in RSI, sort of said, okay, the bull is done, right? Didn't really get an outright short signal out of this. I suppose one could argue you did get a shorting signal here. But that's, that's kind of like this signal here. Yeah, kind of iffy. But nonetheless, first M, second M, sell signal, and that's sort of what that move was there. Coming into these lows, like I said, well, actually, I didn't say I was talking about that one. But anyway, coming into these lows, gee whiz, here comes divergence again. And you could argue 1 W, 2 Ws. Actually get, nice sort of, okay, the bear is done signals here, which I think is valid. And then more consolidation, and then more Ws, and tried to M out here. Is the bull done? Nope, W, and then a bigger W. I think the bull came alive here and translated into that rally there. Again, not really any signals momentum-wise, just straight down. Which, ironically enough, actually to me says that this isn't really necessarily a momentum sell signal here. Market did pause, and I suppose if we did put in this big M here and failed through these lows, that could be a really bad sign, and that would have been basically the failure of this level here. And down we go, and hopefully all of you see this big M in price here. So thankfully, phew, we didn't do that. And interestingly enough, we actually have this really cool little base that's trying to form here on the RSI. Put in a single W, and I kind of think I like this one here, this wider W as sort of like, all right, as of this moment here, the bear inertia has been stopped. And I would make the argument that a subsequent W, a second W here, will actually issue a buy signal. And interestingly enough, we might actually even get a little W that comes in there. So keep your eyes peeled, folks. This might actually, if this thing can actually get some inertia, this thing might break out quite violently here. I'm quite, I'm pleased because I mean, this range is driving us all crazy. I mean, for the traders, it would make sense that you simply go in and buy against these lows, and you're going to risk against here, looking for reload zone shots on the upside here. But this has been one hell of an exercise in patience, eh? I mean, you just had to be patient and disciplined. Price wise, I think it does make sense. If you went like boobity boo and said, "Where is my reload zone?" Well, gee whiz, what a coincidence! You can see the market just basically stopped in there, right? And is that a letter of the alphabet? What's this low here? This low is 61.2478, and this low is 61.31. 61.2478, 61.31. So technically this is a W. Boom. W. In your face. This is off of Trex, and this is the tether. If I'm not mistaken, Phoenix went to new lows. If anything, what we should probably do is maybe let's go look at Stamp. It's as they say, the cleanest of the prophets. Yeah, that's a bad joke. If anybody knows who said that, I'd be darn impressed. But he wasn't talking about Stamp, that's for sure. Okay, this low here is 60.9438. Everybody remember that number? 60.9438. So 6,100. So that's a W as well. Son of a bitch. So actually, there's a double bottom working here, guys. I don't know whether you guys are aware of that or not. There's a W there. So, and the interesting thing is it actually has 2-bar confirmation there. Doink, doink. So technically, there is a W working here. Nice little inside bar here too, to actually get you long following the W confirmation. A nice little inside bar there. So actually, I'm getting some interesting little long signals here on Bitcoin. That's surprising. I really wasn't expecting that. On trend lines, and actually we just did this for the level 2s yesterday. What did I want to look at? Well, I suppose. Yeah. This kind of perplexed me. And now we're going off to these derivatives markets. I would be very careful interpreting too much into the derivatives markets. Should it surprise us that this OK coin did go and take out this low? No. Typical OK coin, the casino. What a shock. I don't know whether did Phoenix go and actually take out those lows or not. I'd be interested to see. Let's see if Phoenix did. So this low on Phoenix was 61.1950, 61 even. Interesting. So this one did not double bottom. It actually did go to new lows there. So a little suspicious. Really simply put, and actually I kind of think this could be an Elian James, LJ. We go boo to boo to boo. Can everybody see we can get actually a nice little LJ long setup if we can fire up through this eye. There, nice W. Down, up, down, breakout. And you're just going to simply risk against this bottom range here. So I think that when I look at this and I see this potential setup, and you could argue, and I suppose that's off of this bigger trend line, there to there to there, right? That's breaking out now, but I think we're running into this trend line resistance here on Tether. Where should we put that? something like that, there to there. Not really the best at this. So it looks to me like this is sort of our playground right now. But the point that I would make is I really do like the idea of there to there, wherever the highest high is, to there. If we can, again, get our butt up through here, W our way here, this thing might have some octane behind it. I mean, this is encouraging. You got, I totally love the idea, candle body lows, wicks and tails like to be eaten. If you want to go throw in a stink bid against this tail, see if you can sneak your way in here. On these other alts that are denominated in US dollars, like this tether, I still have my bid working off of the bottom here on this guy, on this ZEC. I'd be more than happy to try and pick some up on a test of these lows and risk against this low. I don't know whether that's going to happen or not, though. Tough call there. And also, too, I'm watching Sjord's buddy, OMG. Right? And I actually said that I'll be more than happy to buy this W. I took my chance on this W, and I got bitch slapped. Here comes the next W, and this is a trader's life. You never know how many of these damn W's it's going to take to actually get the bottom. But in essence, I'm ready, willing, and able to buy 380, 310 there and risk against this 295, right? So risk maybe about 80 or 90 cents on the trade. So I've got that on the docket as well. So I am ready, willing, and able to participate on the long side of the market. I'm just waiting for these bottoms to come in. And of course, see if I can get my fills off of appropriate levels. If I'm out with Liam and this thing blasts off, then I'm going to have to do the same thing that I'm doing on the ZEC and just work my bid, and reload zones. And you can see 61, if, we blast up against these highs, I have no idea. Maybe we go as high as that. You're going to notice that the reload zone is probably going to line up with this structural breakout level. So if I'm here and I'm not away and this signal comes in, I'll just probably go buy some. If I am away and this thing pops, then I'll draw my RLZs and I'll work my bids at RLZ zones. All right. Did a little bit of nibbling in the altcoin space. Nothing really serious, just little nibbles. I had an, unfortunately, Trex is going through their games with delistings. And one coin that actually has treated us really well over the years, I had a stink bid to buy it back against the bottom end of this range. And you can see Trex comes out. We're going to delist the fucker. And boom, down she goes. Boo, hiss, boo, jerks. So I am long from this reload zone in here. I bought, I think, a total of like 0.03 or something like that. How much was it? 0.04 BTC. And I've already moved it over to Cryptopia. It's already been moved. So be aware of that. Certainly not betting the farm. But, hopefully everybody can see why I'd be interested in buying this thing back down here. As long as it's on Cryptopia, I'm okay with that. I'm not going to say I love it, but I'm okay with going and buying that position back down here. And like I said, I put 0.04 BTC into it. Big whoop. As well, I bought a little bit of this salts recently. Same sort of logic. Basically, it came right back down against the bottom end of its range. This is a weekly chart. All right, so a little bit of a double bottom that came in here on the dailies. I went and did a little nibbling there. I really like the OBV study here. And it looks to me, I don't know whether that's confirmed yet or not, but it looks to me like this thing, I mean, what do you think, guys? You've been working with me long enough. Does it make sense why Brian would be in here nibbling? Again, I put in a grand total here, 0.037 BTC. Not much money. But nonetheless, I like this name. I've heard lots of good things about it over the past years, or unfortunately, with this whole, is crypto a security, right? That's cast a big shadow on this. Might get turfed off of Trex. Tough to say right now. But I don't really mind the idea of doing a little bit of nibbling here. And then finally, I bought a little bit of Alex's coin back, but I can see that it doesn't look like he's quite ready to go. But you can see the original breakout. And keep in mind, this was Gembox, so technically it could still work its way a bit lower down in here off of the original Gembox levels. But we came back down into this original bottom, and so I did a little bit of nibbling here. And I bought the, I think it was just the reload zone of this range here, right there to there. I had my bid working down against these lows. I think there was a nice little gap down there. You can see that it kind of fell apart here. So by all means, if you are trading this stuff and you're like, Brian, I don't want to ride this fucking thing into zero. If it fails the range, then get me out. Well, fine. Basically, you should walk away from this thing right now. I don't have a problem owning this down here. In this case, I put a grand total of 0.046 BTC into this, $300. So be aware, I've done a little bit of nibbling here, but I'm not overly impressed with any of the sort of setups I've seen here. I don't really consider them, tradable trades, just more nibbling nibbles. I definitely do not think that a name like Ubic is going to zero. Really, I don't mind betting on Alex. I think Alex, we're going to find out down the road that Alex is one of the winners of the crypto story. That wouldn't surprise me one bit. I did notice a couple people were banging out doubles over the weekend. I think I saw Andrew said that he banged out a double. And of course, Josh was in there posting ideas on a regular basis. I don't know whether, I think RDD, if I'm not mistaken, Daniel got a double off on this thing this morning. The number of names are out there. But I still don't think we're in sort of that, runaway bull market. It's still very much a coin pickers market. So hunt your setups. If you are not manually nibbling and you're actually putting some serious dough to work as a percentage of your portfolio, then God's sakes, if we break the bottoms, get the hell out. But I don't have a problem if you were just like, Brian, I've got some money sitting on the sidelines. I'm busy, whatever my career is. I'm just going to place some nibbles, bids, sprinkle them against all the lows, ends, and ranges here, and just start accumulating this stuff slowly over time. I wouldn't have a problem with that. And as I told you, I gave you 3 names that I've been doing that on just recently. So I think I'll probably leave the video at that for today. A little bit of Economics 101, a little bit of commentary on crypto and Bitcoin. We're close. We could be actually in for a nice little rally window here. It would be nothing more than just a counter trend rally within a bear market, but nonetheless, call it a relief rally, if you will. Did we get any news about that ETF stuff? Isn't today supposed to be the big SEC news ETF day? So keep your eyes open for that. Maybe that's a catalyst that'll launch the market higher. I definitely like the idea of people hunting longs. I think on the actual sort of U.S. dollar denominated names, we've given you a couple ideas. I'm interested in this OMG, the Zcash. I think also too, we saw bottoms. Like hell, you could play Bitcoin if you wanted to, as well. Litecoin, it's got double bottoms working here. If you want to try and sneak in off of that double bottom, there's also this double bottom. That's a Joby gap. So if we go through that high, then this thing's going to take off. So there are ideas out there to play if you want. Yeah, Quacker. I noticed Quacker was looking really good this morning. Yeah, I haven't talked to, and if anything, it's good to see that these little ones are coming back because it just goes to show that, are they going to zero? I don't think so. And hopefully everybody can see the W's that are forming here. This isn't rocket science, what I'm trying to show you guys and teach you guys. It's pretty cliche. And it's just a question of just, building your plan, coming to the office on a daily basis, doing your work, right? And just hunting this stuff. What do you think? That's not a bad looking coin there, right? Not a bad looking coin whatsoever. And the thing is here at 56 sats, you got to have a move to what, about $1.10, $1.20 to get a double. Is that realistic that we trade back to that level? It's not unrealistic. You can nanny nibble this shit, right? And just say, look, I'm just going to work my open order here and just be patient. You could trade the setup and just simply say, if we fail against these levels, I'm going to walk away. It's pretty straightforward stuff. So thank you, Joshua. I appreciate that. Great looking idea for people to consider here through the day. Okay, I think I'm done ranting. Hope you guys have yourselves a great day. I'm heading off to be with the boys shortly. So I'm going to finish up my work here on the site. If there's any questions, feel free to ask. Level 2ers, you should be busy working away on your horizontal support and resistance and trend line challenges, tricking your charts out. And the end of this week, we'll start with the level 3ers, your pro traders workbench, and make sure you have all those tools in place. All right, everybody, have yourselves a great day. I don't know whether we have Thomas in the daily brief tomorrow, but if we do, great. If we don't, no big deal. We'll roll with the punches. So have yourselves a great day, everybody. All the best, and bye for now.